Okay. So we said earlier that technical analysis is a price prediction method that is based on studying price pattern and volume. And a very important rule in technical analysis is that history repeats itself. Okay. And volume, what is volume? Basically, volume is measured the number of shares traded in a certain period of time. Okay, so it's volume today, for example, it means how many shares or stocks are sold and bought today. Okay, now as we said, we have to look at charts, at price charts. So what is a price chart? It's simply a price chart is simply the stock's price plotted over a time frame. Okay, so the y-axis is the price basically, and the x-axis is the time. Okay, so it's how prices move with time. Now the main types of price charts are line charts and candlesticks stick charts. Okay, now you may be very familiar with line charts because you know they are very simple and widely used, and you're gonna also see candlestick charts and see if we can use it and see which one is better. So in this here you can see a line chart and a candlestick chart of the same company which have the ticker UPS at the same interval of time. So as you see, these charts are basically the same. The only difference is this is a line and this is candlestick chart. Now what is candlestick? Each one of these, like rectangles and straight line, each one of these is called a candle. Now, why would we look at something like this? It looks like very complicated and ugly, to be honest. Okay, so this looks more peaceful and more simple. But maybe as we explained or as we discussed last lecture about what makes prices move. We said what makes prices move is orders of people. So maybe candlesticks shows us things more than the line chart about the supply and demand. Okay, so let's see. So in order to be able to read such a chart, we have to start with reading each candle alone. That's why we can now talk about candlesticks and their patterns. Candlestick is a style of financial instrument used to describe price movements of a security derivative or currency for a period of time. Let's see what do we mean. So basically, as you saw, these two are the candles. Okay, so on the chart you saw red candles and you saw green candles. So how to read these? How to read these? First of all, each candle represents a certain period of time. So we have this candle may represent 1 day. Okay, this candle may represent 1 minute, 1 hour, 30 minutes. Okay, now let's assume now that this candle represents 1 day. Okay, how to read it? Now, if it's green, then this day the price went up. Okay, if it's red, it means that the price went down. Now, let's see how to read the green candle, which means that the price went up. This baseline over here is the open price. Okay, so the price opened over here. Now, the upper one is the close. So the price closed over here. Now, since the close is higher than the open, so which means that the price increased today. Therefore, the candle will be colored green. Okay, but what about these lines which we call shadows or wicks? Now this means that the price reached here but it didn't close here. So you know, guys, that the stock market, as we said many times, open at 4:30 and close at 11. So maybe it opened here, went down, but it didn't close yet. It's not 11 p.m. yet. It went up, but it didn't close over here yet. When at 11, it's at this level and it closed over here, so that this candle will be formed. Okay, the open and the close over here. And the close above open, so it's green. On the other hand, the red candle is in the opposite. The price opened here and it closed down here. Okay, again the shadows, which means maybe it opened and went up, it went down, but it didn't close. It closed when reaching this. Because it closed under or below the open price, it's gonna be red. So this is basically how you read a candle. Okay, it's very simple, it's very easy. Now we have types of candlesticks. Okay, we have types, we have shapes. Okay, let's see. Now the big candle, big red candle. Okay, as you see, it's a big candle. Okay, now what does this shows us? It shows us a bearish pattern. Now we mean by a bearish that prices will go down. Okay, so here we mean it's when you see a red candle, this means the market is bearish. Okay, prices are going down. Big red candle shows you that the prices are going up. Okay, now why we specialize big candles? Okay, because big red candle shows you many people are selling. Okay, because we said that the prices are affected from people's order. So if it's big red candle, then many people are selling. So all people have the same idea of selling this stock, this anything. Okay, and if it's green candle, we have a big buying power. Okay, so all people are agreeing to buy it. Now we have the dojis. Okay, the dojis, as you see, it's a black candle, or it have no color, neither red nor green. Now what does this mean? This means that simply the price opened here, went up, went down, but it closed at the same price. So what does this shows us? This shows us that the market is neutral, or another word that I like to use, there is indecision in the market. What do you mean by indecision? Some people think it's gonna go up, so they bought and raised the price up. Another equal number of people have the opposite opinion and they sold. Okay, so someone took the price up, someone took the price down, it remained the same. Okay, or someone took it down also. Okay, so this shows market indecision. People are indecisive if this price is high or we have to sell it. Now a long leg doji, it's the same as the normal doji, but shows even more indecision, stronger indecision. Okay, people here are more indecisive what to do. Okay, some people buy, some people sell against each other. Okay, we have also the grave stone. Basically this shape, it opens here, it went up, then a big selling power made it go down again. So it's called the gravestone. Now guys, I want you an important note here. I don't care if you remember these names. I don't want you to remember these names. Okay, I want you, when you look at the like when you look at this candle, I don't want you to say that this is a grave stone. I want you to say that the price opened here. First, we have a big buying power, then sellers took the power. Okay, so we have a big selling power. What does this mean? Maybe in the later days, the price will go down. Okay, and we're gonna talk about this in some minutes. Okay, so I want you to understand what the candle is to tell you. I don't care if you remember the name. I even forget the names. So candle type is the dragonfly. It's basically the same as the gravestone, but in reverse. So the price here went down, big selling power, but then, okay, the important thing is what happened next. A big buying power when let it go back to its initial price. Okay. Another is shooting star. Okay, basically the same as a gravestone, but you know there is a small difference. Basically the same. And a hammer is this one, also called a hanging man. Okay, and now we're gonna talk about the hanging man. Okay, it's basically the same and shows you the same thing. So price opened here or here, went up. Okay, then we have a big buying or took it down again. Now, patterns. Okay, the patterns may tell us something important and may يعني if you, as we see, we saw candle types. Now these candle types, if we put them together, they make candle. Candle patterns tells us things that are interesting, that predict for us their future. The first candlestick pattern is the bearish harmony, okay, which is simply this one, a big green candle, then inside the body a small red candle. Okay, so when you see this, it's meant that what this tells us? This tells us that in the near future the price will go down. The question is why when we see this that go down? Okay, we have to think logically about things. Here we have a big buying price, big buying power. Sorry, a big buying power took the price up. Okay, and it closed here, right? It opened here, closed here. The next day, the price opened here below and went down. This shows us that the buying power is exhausted. No more buying power. So no more getting up. Price is going up. And we have a big selling power because we have a gap first. It closed here, opened here. Okay. And we have a decrease in price. So now we have selling power. So we believe that the price will go down in the near future. The same thing, but in reverse for the bullish harami. A big red candle, okay, very strong selling power. Then inside the body, it doesn't have to be perfectly in the middle. It can be closer to this side or closer to this side. But this shows us that we have a buying power because a price gapped up. You know, this opened here, closed here. The next day it opened here and it went up. This shows us that the selling power is exhausted now and we have now a buying power. Okay. Another candlestick pattern is engulfing bullish. It's the pattern is this. So you have a red candle. Okay. The patterns predict the third day or even maybe a week later. Okay. If we take each as a day, yes. So if this candle represents 1 day, okay, this means that the later days. If this candle represents 1 minute, this means that in the later minute things will go down. Okay. So حسب the time frame you're using. And we're gonna talk about this. I have an important remark about this, by the way. Now, the engulfing bullish is simply this pattern. It's a red over here, and then a green candle engulfs it. Now, this also shows us that things are gonna go up in the near future because the selling power is exhausted and we have now big buying power. The same, but in reverse for the engulfing bearish, okay, which is a green candle, then a big red candle, which shows us that the buying power is exhausted and now we have a strong selling power. Another important candlestick patterns is the morning doji star and the evening doji star. Here it is. The morning doji star is this one, red candle or a series of red candle, then a doji down. It doesn't have to be a doji. It can be a gravestone. It can be a dragonfly, the one we saw, these shooting star hammer. It can be these two. It doesn't necessarily be perfectly a doji. Now, the second day, if it's green, okay, this means that the prices will continue up. Why? We shouldn't do anything without understanding the logic. Okay, guys, so I'm not here like the YouTube videos that you go and watch, which make you memorize things. It's not about that. You have to understand what's happening in the market. Okay, so here the price is going down. Now we have indecision. Okay, we have indecision. The next day, it seems that that people agreed that the price will go up, and so that things are gonna go up. Okay, the evening doji star in reverse, it's going up. Then a doji indecision. Okay, we have indecision. Then prices, people agreed here, a red candle. So people agreed that it's gonna go down and it's going down. Now, a very common mistake is that people only look at these two. Okay, so a red candle, a doji, khalas, they buy and things gonna go up. No, this may not happen. So maybe what happened, a red candle, a doji, indecision, but then a red candle. Things will continue going down, okay, because, okay, there was indecision, then they agreed and no, it will continue going down, so it will continue going down. So you always have to wait for the third one after a doji. Okay, don't forget that. Many people forget that. Okay, you have to wait and see where the market is going. So this is the morning doji star and the evening doji star. Let's see some examples on doji stars. As you see here, the price was going down. You have a doji star indecision in the market, then a green candle, prices went up. We can spot another one here. Prices going up, doji, red candle, things went down later. Okay, the same thing here. Now, oh look, this is a good example. A green candle, indecision, another green candle. Okay, so but later it was also like indecision, and then prices went down. Okay, the same thing here. Okay, the same thing here. Prices were going up, dodgy, and prices went down again. Okay, so this is how, guys, you read a candlestick chart. Let me go back to this chart. Now you see, guys, the difference between these two, that this one tells us many things more than this one. Okay, this one gives us more information about yes, that one was yes sideways. We're gonna talk about that. Back to this. Shows us more details about the supply and demand. This shows us more details about the people's orders. This shows us nothing, to be honest. So, guys, if you want to be professional trader, you have to use candlestick charts, because they show you what's happening in the orders of people. Because as we said in the last lecture, what changes the prices is only the people's order. So we have to watch for that. And maybe the gap over here, we can't see it here. This gap may mean something. Okay. So this, for example, doji over here, we can't see it over here. Okay. Now let's go back. There are hundreds of candles and names. Okay. So I showed you some names. Okay. And some patterns, but there is literally books that teach you 100. Okay. But that's important. Why? Because I don't want you guys names of candles and names of patterns. That won't make you good. Okay. And what these candles and these patterns are trying to tell you. And if memorizing hundreds of candlesticks and hundreds of patterns will actually give you advantage on making money in the market. Okay, so all the people who are making money memorize candles, but that's not the case. Okay, that's not the case. I know many people who have names of candles and they memorize it. I really don't do that. But anyways, they make no money and they lose. Okay, so it's not about that. It's about understanding what the candlesticks and the patterns trying to tell you. Okay, that's the important thing. We're gonna talk about trend lines. Okay, support and resistances. What are trends? A trend is a general direction of price of a market, asset, or anything. Okay. There is a saying that says the trend is your friend, so don't go against the trend. Okay, we're gonna see what are trends. Trends are the core of technical analysis. Okay, on trends, it's mainly based on trends. And in technical analysis, as I said, we believe that the prices move in trends and that history repeats itself. So let's see what are trends. There are three ways of trends. Okay, there is an uptrend, okay, sideways trend, and a downtrend. Okay, so a trend is basically a direction of the price moving. So if the price moving up, we say it's uptrend, and it have higher highs as we and higher lows. The sideways trend, it moves like this. Okay, a downtrend, it's basically the price going down. So you have lower highs, this high is lower than this one, and lower lows, this low is lower than this one. Okay, so these are the three main types of trends. Now, technical analysis says that trends persist. Okay, so if talking an uptrend, it should continue moving trend until something happens and change it. And now we're gonna see examples. Okay, a trend line is now okay to help us see or spot. We use trend lines. Okay, so trend lines help us to see the trend. Okay, and we have two main types of trend lines. The one that connects the highs is called resistance, and the one is that connecting the lows is called a support. And now we're gonna see why it's called like this. Okay, and drawing support and resistance will give you a channel in between, and we'll see over here. Now here, for example, we have an uptrend. If you connect the lower points, you have this line, and this is support. Now see guys, this is a support, so which means that the price shouldn't go below it, supporting the price. Okay, now here it went below it. Now we're gonna see this why. I said trends persist unless something happened, and here we can see clearly that something happened. Why? Because the volume, this is the volume, and we're gonna talk about it. The volume here, which is shown in bar graph, is greater than the usual. So something happened here and it changed the trend. Now we have a new trend. Okay, but usually, as you see, it's moving on the support. So the price, every time it will bounce. Now let's see a realistic example over here. As you see here, guys, we have this stock moving. We have these two trend lines. The ups, it's connecting the high points. This is the resistance. Connecting the lower points, this is the support. And as you see, guys, every time the price tries to hit support, bounce back up. Every time it hits, bounce back up. Unless something happens and it break it. The same for resistance. Every time it touches here, it bounces down. Every time it touches here, it bounces down, as you see. Okay, so these can help predict the price. So every time it touches the support, I buy, and it bounces, I make money. It touches the resistance, I short. It go down, I make money. Okay, but we're gonna discuss exactly how to know that if things will go down. What is keeping it from breaking? That's what I'm gonna talk about now. That's what I'm gonna talk about now. No, it's not because of big investors. Let's see why. As I said in the last lecture, guys, what makes the prices move is the orders of people. And you are looking at this, and not only you are looking at this, okay? Not only you. Millions of people have already drawn these two lines. So see this scenario. If me and you and everybody in the world both, when the price hit this point, we're gonna take the price up, right? Because buying will take the price up. So if all of us both on this point, we're gonna take the price up. So it's like a phenomenon fulfills itself, and this is this is why the stock market is very beautiful. Okay, look, every time it hits here, me and you and all people will buy, and when we buy, we're gonna take the price up. Okay, so we do it by ourselves, and not only me seeing this, it's you and every people and all people around the world are seeing this. Okay, and that's what price like this. And now I'm gonna tell you something. As you see here, the support is at exactly at $20. Now we're gonna discuss this. And here it's exactly at $27. Now we're gonna discuss why is this, and I'm gonna give you a proof about what I said now, that these prices are because of people buying and selling at the same time. So all of people are shorting. Here all of people are buying. So we are taking the price in this way. Unless something news, a very big news happens, and so let's say at this point a very big news happened that news is gonna go down. So all people shorted exactly, Michelle, limit orders at 20, at 27 exactly. Now we're gonna talk about. So imagine that here we heard the news and that no one cares anymore about that, and because of the news, all of them started to sell, so it break. Okay. Now role reversal, which is very important. Roll reversal is when the price breaks a trend line, it reverses its roll. What do I mean? So if the price broke the support line, this line becomes a resistance. Okay, so every time a trend line is broken, its roll is reversed. Okay, and we're gonna talk more about details in a minute about it. Now, round numbers. Round number is what Michelle was talking about. Round numbers is basically the it's rounded and it have short decimal part. Like 27 is a round number. Okay, 26 is a round number. 26.5 is a round number, but less strong. Now, most of the time you can spot supports and resistances on round numbers. Why? Okay, because if people want to send limit orders, okay, they will send a limit order at $20. They won't send a limit order at 19.735, for example. Okay, so we're gonna send at 20. That's why you find a lot of odds and resistances on round numbers. Okay, let's see some, and I'm gonna give you like a small tip. Okay. We're gonna see later. Now, we're gonna see round numbers, but I want to give you a tip. Like all these guys, never put order round numbers. Why? Because as I said, as we discussed in the last lecture, that the stock market or the exchanges, it's the first come, first served. Okay, so if you put your order on a round number which have many orders there, it's very hard for you to get filled and you might not get filled. So always put it somewhere below or above. I'm gonna talk about this when the examples come. Okay, but never ever put an order on round numbers. In trading firms, if an employee put a limit order on a round number, he's directly fired. Okay. So another example on trend lines. So as you see, this is a trend line. It doesn't have to be like perfectly perpendicular. It can be inclined. Support, resistance, and this is a channel in between. Yeah. And this is a channel in between. Every time it hits down, it bounces back up. Every time it hits up, it goes down. Okay. And you see. Okay. Now here also we have another channel. Resistance. We can know these guys simply. Okay. So, for example, this support can be drawn using these 2 points only. Okay, and you draw it, and see after a while it worked. And these two, you can draw the resistance. You can draw it from these 2 points. And it worked 1, 2, 3, 4 times in the future. See, so you can predict the future now, guys. Let's talk about chart patterns, which are very important. Chart patterns are patterns, okay, that we can see on the chart, which can tell us how the price will move in the future. Okay? And what is the period that needs to be looked at to get support prices? Depends on you can do it on 1 day, you can do it on 1 minute, you can do it on any time frame. But let's discuss something important here. We talked about it. So if this is a daily candle, okay, and the price hit it here, okay, if the price hit it here, you shorted, okay. Now it will take days for the price to go down, okay. So if you shorted over here and it's a daily chart, yani make sure that you have to wait some days, okay. Because I know people, for example, who are using a daily chart, they short over here and they sit the whole day in front of their screen. Oh my God, it went up. Oh my God, it went down. No, mama, you have to wait. Okay, you have to wait. And sitting on the screen and get your nerves hurt. Okay, and you won't be you will be nervous and you won't be deciding good anymore. So if you're using a candle 1 day, okay, you have to wait for some days for the price to go down. Okay, you can also draw a middle line so that if you shorted here, you sell on you buy again on the middle line. Okay, and if you're using a 1 minute chart and this hit here, so you have to know that in some minutes it have to go down. Okay, but don't use a 1 minute 1 day candle chart and short over here, for example, and remain the whole day looking at this chart and getting your nerves burned. Okay, I know many people do that. It's not healthy for your nerves and for your decision making. Okay. Now let's talk about chart patterns. We said what are chart patterns. So pattern number one, head and shoulders, not the shampoo. Okay. So this is the chart pattern. Okay. You simply you find two shoulders and a head in between. So shoulder, the left shoulder, the head, the right shoulder. Now, what does this tells us? This pattern tells us. Usually, after this pattern is seen, and also we have the neckline. Okay, this is the neckline. Okay, usually when this chart is seen, okay, the prices will go down. Okay, so after the right shoulder, the prices will continue and break the neckline, going down. Okay. And note, you can see the head and shoulders, but inverted, guys. Okay, so you may see the head down and it's not like ups. Okay, it's downs. You may see it inverted. Okay, it's not only like that. May be inverted, and the neckline will be up, and it will break the neckline going up, not going down. So this is basically the head and shoulders. Okay, don't worry, guys. You may now be saying, okay, how would I find something like this? Should I go and search a stock by stock to find this? No, you won't. I will, at the end of the pattern, this topic, I'm gonna give you a website you can use, which is called a screener, to find these. Pattern two, the double tops. And this is basically the double tops, which is a horizontal resistance, which is touched once and twice. So now we have a double tops. Note that this resistance is at a round number. Okay. Now double tops over here, which means what? Which means that this now is confirmed to be a resistance, and the third time it hits it, it's gonna bounce down again. Okay. So this is basically the double top. Now the multiple top is the same as the double top basically. So, but instead of only 2 times, it's more than 2 times, which actually makes it more stronger. So this is the idea. Okay, as more and more a resistance or a support make the price bounce, as more and more it becomes stronger. And again, note that here it's a round number at the resistance 29, no, a round number. So as you see, if you see these two, then this you can short here, you can short here, and as you see, the price went down, and you can make money of that. You see, making money is simple. As the double tops, I think you guessed it, it's the double bottoms, which is in reverse, and it's also on a round number. So this is a support 2 times. The third time it will hit, it will gonna bounce back up. Multiple bottoms, they're the same. Okay, and here not a very strong round number, it's 22.5, but we have a round number here as a resistance at 27. Anyways, the multiple bottoms, it's what it touched more than 1 time, making it more and more strong. Okay, pattern 6, which I really love, okay, are wedges. Okay, and sometimes we're gonna see them by the name of triangles. Okay, and I'm gonna explain the difference. Now a wedge is basically this. So you can see an inclined support and an inclined resistance. But why is that very important? Because as you see, at last there is a corner. Okay, so what does this means in terms of logic? This means that with time, buyers are getting stronger and stronger. Okay, you see, every time the buyers are buying higher than this, buyers are gaining power. And here also the sellers are gaining power. Every time it touches the top, it bounces down, it's lower than this one. This is lower than this one. So also the sellers are gaining more power and power. At last, they will be in a corner. Now here, when they go into a corner, the price will explode, okay, in either direction. It may explode up, it may explode down. So if it's exploded up, as you see here, you can buy. If it explode down, as you see, if it's exploded down, you can short. Now, always, guys, after it explodes, it always have to retest, we say. So again, so as we said, this is a resistance. It break it, so now it have to be a support, right? By role reversal, it's gonna test it again. So it's gonna go up, test it. And here, two scenarios might happen. It will continue going up, bounce, or it's gonna enter again inside the wedge. Okay? So this is the retest, guys. So now some people, if it broke, they wait for the retest. If it went up, they buy. If it went down, they short, or they do nothing because it went again inside the wedge. Okay, but what I do is that when it break, I buy again. I buy. Okay, why? Because I don't want this move. And when I feel that it's testing, I sell. And then when it retests, I do like the other people do. If it bounces, I go and I don't do anything. Okay, so I take advantage of this move over here. You can do it, and you can simply do as other people do, which is you wait for the retest. But I advise you to do it. You know, it's a good opportunity while losing it. Okay, so this is basically the wedge. It's being more in a corner, and then it will explode in either direction. Now, a triangle is the same as a wedge, but one of them is horizontal. So one of them is gaining power, and one of them is having basically the triangle. But the same, they have at last a corner. And you also have a wedge up and a wedge down. So the whole, the major direction is going down. The major direction here is going up. Okay. Now, what does this makes different from this? Here, it's more probability that the price will explode because buyers are gaining power faster than sellers. In a wedge going down, sellers having more power, gaining more power faster than the buyers. So more probability that it goes down. Cases which is تقريبا it's equal here, it's very interesting, okay, because it can explode in either direction and in very big explosion. And as more and more it gets squeezed in the corner, the bigger the explosion. Okay. Patterns. Okay. What if the corner well, if the corner is first and then the lines widen up, that won't happen. How can you draw something like that? But if you can draw something like that, it's useless, okay? Because it's like something like back. It's like, say it's inverted, like going back. Okay, you can't know. Okay, you can't know what's gonna happen, and it's very rare to happen. I actually never seen something like that. And if something like that, like don't draw it. What he means, guys, is that imagine that is inverted. Okay, so the prices are moving in this direction. So the resistance is like this and the support is like this. So don't draw them simply because they won't be useful. Okay. Okay. Is it safe to assume that if the buying power is going faster, that the price more? Yes, of course. That was what I was saying. That's what I was saying. This is between wedge up and wedge down. Wedge up, the honey buyers are getting a power rate themselves, so more probability to go up, to explode up, and reverse here. Now, finding patterns fast. As I said, guys, you won't like go to the stock market and search every stock and try to make a pattern. You have finviz.com. It's a screener. What do you mean by a screener? I said sometimes a screener is a software that tries to find you the stocks that you want. Okay. So on this finviz.com, it's a screener. Okay. It can do the chart patterns. Okay. And finviz.com also shows you important fundamental ratios, numbers. Maybe we're going to talk about that later. But let's say today, guys, I woke up and I want to trade a wedge. جاي عبالي اليوم a wedge. Okay, I go to finviz.com. So finviz, this is the main page. You scroll down a little and you're going to see these. So we talked about the channel up, channel down, double top, multiple bottom, head and shoulders, wedge down, triangle, exactly the same as the wedge. And to I go to finviz.com, the main page, scroll down, and it will shows you many the wedge pattern. Okay, and it even draws them for you. Am I lagging, guys? Okay, now it's okay. So what I was saying, and I lagged again. What I was saying is that on finviz.com, if you enter finviz.com, you scroll a little bit and you see these. Okay, so if you want to trade a wedge on wedge, okay. Can you hear me now? Okay, guys, can you hear me now? Okay. So what I was saying is that you come to this website finviz.com, you click on wedge, and this website will show you many stocks that are making the wedge. It even draws for you the lines. If you want a double top, you click on double top, and it shows you more and more stocks making double top. So you don't have to go and search by yourself. Okay, you can get them from here. Now let's talk a little about the volume. Okay, we didn't talk much about the volume. Now, what is volume? Are the stocks available? I think you no, it's only the US market, but if I think there is an elite membership, if you subscribe with the elite membership, you can get, I think, for the global stocks. Okay. Okay, what is volume? Volume, as I said, it's basically how much stocks are bought and sold today in a certain period of time. So the volume today, let's say, is 1 million of a company X. This means that 1 million shares today are bought and sold. Okay, big change in volume can tell us that a trend will end. Okay, and a new trend will come in, because I told you guys, trends must persist until something happens. Okay. Okay. So the volume is measured in the number of shares traded in a certain period, usually a day. Okay. The average volume type. Now, as I said, the volume. Okay, if the volume is big, for example, something is happening. If it's small, if it's very small, something is maybe is happening, for example. Okay. Type. How to know is the volume today is big or if the volume today is not big? Okay. So we look at the average volume. The average volume, okay, it's usually the average of the volume calculated on the past 3 months. Okay, so it's the average of the volume every day, okay, of the 3 months. Okay, so of the today it's greater than the average, you know that today we have a big volume. If the volume today is below the average, you know that the volume today is not very big. Now the relative volume is a better something or a metric to calculate that will give you more, will make you more sure. Okay, the relative volume is basically the volume today divided by the average volume. Okay, So this is basically the volume. So the relative volume can be greater than one. If it's greater than one, then the volume today is more than usual. Okay. If it's less than one, the volume today is less than usual. All right. Not command where to see if there is. Wait, let's go back to so see as these bars down, okay, are volume. So this represent the volume. So the volume here, for example, is 100K. Okay, the volume here is 100K. See, guys, usually the volume is like this, but on this day we had a bigger volume. Okay, and usually when you have bigger volume, a change in the trend happens. Okay. Let's go back. Of the volume, average volume on finviz.com. Enter finviz on the first, on the main page. You can, in the search, you can type any name or any ticker of the company you would like. Okay, and it will shows you many fundamental ratios. One of them are the volume and the relative volume. So please, after you finish the workshop, go there and seek it out. Now, the reason why I will not do it today here, it's because of the time, okay? Because this workshop is already indicators are mathematical and financial technical analysis to predict price direction. They are made depending on prices and volume. Okay, what does the color mean in the volume bars? Yeah, if it's red, then the sellers are more than the buyers today. If it's green, then the buyers are greater than the sellers. But that doesn't interfere with the number. Okay, so the number may be 150K, but 150K and it's red, for example. This means that there are 150K bought and sold, but the sold are more than the bought, but the total is 150K. Okay. Yes, exactly. Yeah. You're welcome. So indicators are mathematical tools. They are made or depending on the price and volume. Now here today, I will show you on some indicators. Okay, I will show you on. Come in, guys, before I forget, a note about the chart patterns. Come in. The chart patterns, you can also have many chart patterns. Okay, but you should, and as you see, all the chart patterns depend on the supply and resistance. It's not important that you go and memorize hundreds of them. It's important that you can understand what's going on. You see how we analyzed the wedge. The buyers are gaining power faster than the sellers. Okay, or the channel, both of them are having the same power, for example. So I don't want you guys to go and memorize hundreds and thousands of them, because I know many people who do and they don't make money. I want you to understand what they mean. Okay, I want you to analyze what they mean. That's the important thing. Okay, please. And indicators. Okay. That today I won't explain how to actually calculate the indicators. Okay, because indicators are mathematical tools. They are made or calculated depending on prices and volumes. I won't discuss how to do them. I'm going to show you some indicators. There is hundreds of indicators, but I'm going to show you on the most important ones, because the most important ones are the most used ones by people. And because many people use this will make the biggest effect on the market. The same for the patterns, the same for the candlestick patterns. I showed you the most important patterns that many people use, okay? Because that's what will affect more the prices. And if you go and use an indicator that nobody use, that will make that many people use, okay? The difference between the stock market and the school or the university is that in the university, if you know something that nobody knows, that's a good point. stock market or in any market, any financial thing in your life, if you use something that nobody know, you will lose. Okay, so always use what people use. That's a very important point. Okay, we won't derive how to calculate this because it will take a lot of time, but I'm gonna explain for you how to use them. Okay. As I said, there is plenty of indicators. 80% of them are useless or they imitate each other, but they have different names and different colors and features, okay? But they are the same. We'll see some of the most important. Okay, what we discuss today are three indicators. I think you already heard of them. They are the Bollinger Bands, the ATR, average true mean, and the relative strength index, okay, RSI, and which also have another two, basically the same, stochastic and commodity channel index, CCI. Okay, so, let's stop now and go to another software for charts to see some examples on the indicators and show you some examples on what we talked about, like patterns and something like that. Okay, so okay, guys, whenever I lag, tell me please. Okay, so you can see now trading view. Right? So trading view is the software used to mainly chart, okay, for charting and for usage of indicators. Okay, so let's see. The first indicator, let's get familiar with this. Okay, let's get
Marwan,
familiar.
you're lagging a lot while speaking. Can you repeat some of the parts, please?
I think because of opening these softwares. Let me close some tabs. It will help. Okay. Is that okay? Because I'm using also 4G and it's the same. It's because the software. Okay, now it's good, but I can still lagging. Okay, whenever I start to lag, please tell me. Let's get somehow familiar with this. Okay, this is the trading view. It's a software for charting. Okay, in here you can put any ticker you want. Okay, and in here you can change the interval of time. Okay, so I want a 1 minute chart, I want a 15-minute chart. Now it's on 1 day. So each chart, as you see, represents 1 day down. Okay, so this one represents 12 March 12, which is today. The previous one is 11 March, and so on. So this so here you can change from candle to line, but we know we use. Okay, let's start by indicators. We're talking about indicators, okay? We came here on the FX indicators and strategies. So we talked about Bollinger Bands. So let's search for it, Bollinger. So Bollinger Bands, the strategy one, the normal one, the Bollinger Bands. If you click on it, you will get this. Okay, it's already. As you see, this is. If you click on the size over here, you have some on the inputs. You have some things like deviation and length. Leave the length 20s. The standard deviation we're gonna talk about. So Bollinger Bands work. Okay, بلا طول سير bands. It's basically, as you see, the Bollinger Bands is 3 bands. Okay. 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 Mid band is the simple moving average. Okay. The lower band, the band, upper band. Simply, well, price touch the lower band, you buy. Okay, when it touch the band, you okay. Okay, and in reverse, if it touched the upper band, you short. It touches the lower band again. Okay, and let's see another example. It touched here, you sell. You short, you sell. You buy, you sell. Okay, over here, you sell. Now here, if you shorted over here, it didn't go down. And dodge this one. Okay. Here you sell, you short, you I go back is plenty here, sell here. Okay. Now but you understand the concept of Bollinger Bands, okay? Is there any question about it? Simply, you buy on the lower band, you show the upper band, okay? It's very simple and easy. Any question till now? Can we use both Bollinger Bands and support? Yes, of course you can. And you sell in the mid band, yes, you sell for the up. If you feel that it's going back down, you sell. You leave it. Okay, you can leave it. All right. Yes, exactly. When I move the graph, it lags. Yeah, because this takes a lot of because it's live data, so it's a lot of Wi-Fi and 3G. So both of them are lagging. Now, guys, there is something about the standard deviation which I wanted to explain. Now, I don't know if you guys 30, okay? Let's see this one. You see, guys, the is 2. In stat to 30, which is statistics and probability, you know that when the standard deviation is 2, okay, there is probability 95% for the data to be inside the zone of the standard deviation lines. Okay, so what do I mean? What do I mean? That is here, because this Bollinger Band is the 2 standard deviation, you have 5% chance that it goes up out of it, and well, 5% chance to bounce. Okay, you get it? So this is 2 standard deviation. When it touches the up or the lower, 5% break. See it break up, okay, but a little, يعني, rarely, okay. So 5% chance it go up, 90% chance it go down, okay. But also in stat to 30, we learned that in standard deviation 3, 99.7 or 99.97 actually, it's gonna bounce, it's gonna side on 0. So let's take this off and put the standard deviation of 3. This is standard of 3, guys. Let me put the standard deviation 2 at the same time in order to see the difference. Exactly, the outliers will be outside. Look, this is the standard deviation of 2. This is the standard deviation of 3. As you see, the deviation of 3, it's very hard for the price to buy because it's only 0.03%. So, guys, I think you own the market with this one. Okay, you own the market. So, you see more why. What's the disadvantage of the standard 3? Because you make some opportunities. So for example, this one didn't touch, if you use the 3, okay, it didn't touch the up one. So, or let me take another example. For example, this one, Okay, it didn't touch the up, so you may not short here, but the price went down. Okay, so you missed a chance. If it touched like here, okay, you have a 99, 97, and approximately 100% you're gonna make money on it. But show the disadvantage that you get less chances. If you're using the two standard deviation, you have more chances, but on each chance you have less probability to make it profitable. Okay, but 95% is also a very big high one. Okay, it's very big. So this is 95. This is the difference between the standard deviation 2 and the standard deviation 3. Can you draw a trend line here for sure? Let's do it. So here are the lines, guys. Trend line, parallel channel. You can use these two. So a trend line here, for example, maybe this. So, for example, you can use something like this. This is a trend line, for example. See, it broke up and it continued to fire up above, for example. You can draw another resistance connecting these two. When I finish, I'm going to show you some examples on the trend lines. Don't worry. I have them in mind. So this is basically the Bollinger Bands. Now I want to tell you something, guys. This one is not a and I won't lie. Using only Bollinger Bands won't make you make money. Okay, why? Because I know many people of my students use Bollinger Bands only when they trade. I told them don't do that. You have to use a strategy. Okay, you're welcome. You're welcome. I always told them that don't use this. Why? Because a strategy, guys, is more complex than this one. I know what you see on YouTube. On YouTube, you see that this is a strategy that works 100%, and as you see, it really works. But when you go and put real money, you start losing. Why? Because a strategy is not this. A strategy is more complex than that. It's very complex. A strategy is very complex. So a strategy not only have something like this, which can tell you when the price is going to, how many stocks to buy. Here, why I should buy 100, not 200, for example. Why 1,000? Why not 1,000? Okay, and it tells you where to put your stop loss, where you to put your take profit, many things. Okay, a strategy tells you many things. So my students, for example, when they use this, they make many small profits, and then only one loss will make them lose everything they do. Okay, why? Because they are not using a strategy. Maybe they bought stocks more than they should. Maybe here on this one they took profit early. They should have waited more so that their profits will be bigger. That when a big loss came, that big loss won't cancel all the profits. So I won't lie at you guys. This is not a strategy. This is not a strategy. A strategy is more complex than that. But this is a part of a strategy, which is basically a 10% of the strategy. Okay. So this is for the Bollinger Bands, guys. Now, I want to add another indicator, which is the RSI. Now, why? The RSI is very important. Now, let's take some scenarios over here. Now, here, guys, as we said, when it touched the lower band, you have to buy. Now, if you bought over here, you have lost money because the price dropped. Now, you lost on this one. Over here, you have to short, but if you shorted, the price went up, you lost. So we're gonna combine Bollinger Bands with a new indicator, which is the RSI, the Relative Strength Index. So let's see. This is the RSI, guys. I won't go in details of the RSI will how to calculate. Basically, above this line, which is the 70, the thing is overbought. Okay, so it's overbought. Below it, it's oversold. How to use this? Look how to use this. When it goes up to the oversold, I believe. Okay, every time I put okay. All right. Okay. No, when it went up, okay, now it's in the overbought area. When it's going back in here, you have to short. Okay, here you have to short. So let's think about it. Okay, the Bollinger Bands here tell us you have to short, but RSI tell us no, you shouldn't short because it's entering the overbought. Now at the end of the here, okay, it's touching, so the Bollinger Bands agree to short. The RSI also agrees to, okay, here, for example. But RSIs you shouldn't, so you shouldn't, guys. In the now, so wait for it to go down a little bit deep inside. Let's go a little. I hope that won't. Another example is here. Now, the band, the low band, the price touched the low band, so we have to buy. Yes, أكيد I'm recording. Even using 4G, it's not really working good. Here also the Bollinger Bands say you have to buy the RSI, so you want this point both okay, so and you do, and okay, so this is the RSI to pin here. The price hit the upper band. Okay, Bollinger Bands say you have to short. RSI says nothing. Okay, because it's inside the region, it says nothing. Okay, and now, guys, is everything okay? So this is the side. The final indicator, which is ATR. Average range. So the is fixed always above 70. It's overbought. Below 70, it's oversold. Okay, it's always fixed. The range is always fixed. Another, so a combination, yes, of both is very good. Okay, it's very strong. Now, yes. Okay. Another indicator other than is let me show the stochastic. Okay, it's basically the same. Okay, it's basically the same, but it gives properties. Okay, stochastic is the same, but gives you more. Okay, so you're more short-term trader. If you're somehow a swing long-term trader, you use RSI. Another one, guys, is for CPI. Another indicator, same as the commodity channel index. It's the same and it looks the same, but it's used for commodities. So here, guys, we're looking at Forex, USD. Okay, these are foreign exchange currencies. CCI commodities. You can use RSI for commodities, but the CCI is more traditional commodities. Commodities are basically materials, okay, like oil, like gold, like silver, wheat, coal. All of these are materials, commodities. These are commodities. The CCI works stronger and more accurate on commodities. Okay? So if you're using commodities, it's better to use CCI than RSI. And commodities is everything materials. So stocks is not a commodity. Commodities, only oil, wheat, gold, silver, all of these. Okay. The last indicator for today is the ATR. Average. I'm not. ATR average range. So the average range, guys, is simply this. So if you're a short-term trader like this, so let's say we were trading today and someone came and told us, for example, USD Franklin will go up. The first thing we ask is what its ATR. Okay. So what does the ATR? So let's say now the ATR is approximately, you take the average, it's about 0.005. This is daily, okay, this thing, whatever it moves 0.05 every day, okay? So if today, for example, it moved 0.02, we still have a chance of entering this order, of entering this trade, because usually it changes 0.005. Today it changed 0.002. So we still have a chance. But if already moved 0.005, we know that it won't like move a lot anymore. Okay. Now this is more for day traders, for very short traders. It's useful to look at the ATR. Now, in some cases, which big like big news happen, it changes. Okay, but it always go back to the normal. So you can take an average of 0.05. This is basically all the indicators today. There's also many indicators you can search about them, okay, on YouTube, okay, but you should know that on YouTube they tell you this will never fail and this is a strategy, but please don't use this alone. Strategy is more complex than that, okay. I wanted to show you guys some examples of patterns. Okay? So Apple, for example. Stay on talk. So, is it lagging now? Okay, yeah. It won't lag. I'm very sorry about that, guys, but it's not in my hand. This is Apple. Okay, so what happened? What can you see here that I leave the support? Thanks to you. And with me in December exactly. So I heard the news about Apple car or something. So I was like, I want to. Now, day trader, I rarely invest, but like I was, let's go invest. Okay. And when I do investing, because I'm a day trader, so like I don't analyze much things. When you invest, when you are a day trader and you go and like put one investment. Okay, this investment that you put is very small compared for the trades that you do every day. So it like even if I lost it, I don't care. You don't make a big analysis on that. So whatever, I bought here, okay, and suddenly when I bought, prices started to drop. And I saw, oh, look, this one. I bought exactly here. This is buying here because the price will drop. It's a double top. So my mind switched to a day trading price. I lost, of course. And then I showed and I made money on that. For example, you can use this. You always have to take, because like I fell in this. I lost a little bit. It was better to okay. It broke and then retested and uh, still resistance. Now this resistance is very strong. 1, 2, 4, okay, hits and okay. Now the resistance is strong. Now where we are here. It broke a lot. It broke the same day and went up, which is, yeah, if it broke directly, guys, don't like short unless you want to do what I do, which is take the opportunity. Okay. Yes, we will. I did the final thing we're gonna. Uh, so this is a very strong support of it. Okay. Now this is it. The final thing that I want to show you is this. This okay. They see we this wedge I drew it my students back in September. I drew it around here, this wedge, till it gets more a break. It really broke on this one. Like from here to here, and $7 difference in forex. I don't know if forex $7 difference. Okay, so this of the wedges. Okay, so this is everything I want to tell you. It was very exciting lecture. Thank you a lot for attending. I really love this lecture, and I hope that you love this topic too. Okay, so now the floor open for questions. If you have any questions, please tell me. You're welcome, guys.
Okay, thanks a lot, guys, and thanks a lot, Marwan, for this amazing session. Sorry, it went a bit over schedule. We spent like an hour and 30 minutes on this workshop, but we hope you enjoyed it, and we'll be back in 2 weeks, hopefully. So thanks a lot, everyone.
Yeah, thank you so much, Marwan, again, for taking your time and doing this wonderful session. It was very informative. And there's a question from Michel Matta, who's asking if there's a good strategy to use a combination of stocks and options. If you can answer that or ask more or whatever, that would be awesome.
What exactly do you mean? Like a strategy that works on both, or doing both at the same time? Uh, um, yeah, why not? Yeah, that is called. We're gonna talk about this in the second lecture, which will be about risk management. Okay, so one of risk avoiding, okay, or risk management is risk transference, which is actually by what you said. Okay, so by options. Okay, so yes, you can.
Michel Matta, I think the strategy you're talking about when it comes to options, I've read about it. It's called covered call or covered put. So basically, you own some of the underlying, at least, shares, and then you try to play around with an out of the money put or call option. But as an insurance, as you said, usually cover yourself. That's why it's called a covered call instead of being called like a naked call, where you sell a call without owning the actual underlying shares, which is obviously more risky. But it's more expensive. So it's like a trade-off between risk and reward again.
Yeah, exactly. I don't trade, to be honest, options, but I know about the risk transference. It costs a lot. Now, in the next lecture, you're gonna see some risk avoiding or risk managing methods better than options. Okay, so I personally don't and never used options. I did, to be honest. I did options once and I didn't do it again.
The best way to learn about how options move, because as I covered in the first session, I'm not sure if you guys remember, is that they move using these Greek symbols. And the best way to actually see how they move compared to stocks, they move way faster, is to download Webull open up like a free account and start trading them, because you're going to see whenever there's some volatility on the news, the options price is going to increase 3 times in the blink of an eye. You'll see it going from like $1.5, which is $150 a contract, to like 400 in like an hour or two, which stocks don't move that way unless they're like, even Tesla doesn't move that much. It's a very
Yeah,
the way options move is very interesting compared to stocks. And like sometimes you just hold it for one more day and then you end up losing half its value due to like time decay or like an EV drop or
exactly. Yeah.
whatever, which is crazy.
Yeah.
Like it's very
And
riskier. Unless you know
if,
what you're doing, don't get into options.
yeah, look, Michelle, if you next time we're gonna talk about it, but options is literally gambling. Why? Because if you calculate the expectancy, which is the expected value of how much money you will make, it's gonna be always negative. Okay, so maybe you win once, twice, but on the long run, the expectancy is negative, so you're gonna lose. And all the games and the casinos have negative expectancy, and you never saw a casino close, right? So
Yeah, there's a reason why they call these games like zero sum. There's always a winner and a loser. And whenever
exactly.
you're the one who's buying options instead of selling them, you're pretty much like 70 to 30. I think there's a chance of you losing money. Your expected value is much lower because options have something called time decay, like first and foremost. So the longer you hold an option, keeping everything equal, every day it's going to drop like 5 to 6% in value right over there. So imagine you have $100 option, the next day it's $94, and then slowly and slowly 90, and then 87, 86. Every day you hold it, you're losing money. So options are like super risky, and I wouldn't
Yeah.
suggest anyone to get into them unless they know what they're doing or they've at least played around a bit. It's not like
And it's
stocks.
gambling, guys. It's gambling.
Yeah, it's basically a mathematical way of gambling.
Yeah.
It's like going at the casino and just throwing money at something. You can make a lot of money, way more using options, but at the same time, you have to know what you're doing.
And the casino, if you know what you're gonna doing, you're gonna get a mafia beating you up.
So if anyone has any other questions, please type them out, or we'll be going to end the meeting and send the recording whenever it's done.
Thank you, guys. Thank you for attending. And I hope the next lecture you will find it also interesting.